So I just got back to the office from a few errands we had to run, and it brought up a thought in my mind on the way back. That property's got a tremendous amount of potential. It's a recreational farm, 100% timber right now. It was in CRP, some of it, years ago. The owners planted it all to trees. It was a tree program, and of course now it's 15 years later. The trees are well established, but no additional income on it. Typically I find myself describing this to sometimes sellers and also buyers, but it's a law of diminishing returns. And it's a pretty simple concept. Applies to a lot of different fields, not just real estate. But in real estate, it's a big one. And essentially what it is the relationship between how much you spend on the property and invest in the property and how much you could potentially sell it for later. So I've got a whiteboard here. I'm going to run through just a real quick example to maybe help illustrate better what I'm exactly talking about. So if you were to draw a graph, and you've got a vertical axis and a horizontal axis, and we put down here, say, the investment. I'll just abbreviate it. Call that the investment, and we call this the return. So as we come across here, we're increasing, right? We're arbitrary numbers, but whatever these numbers are, as you come from this point, we're increasing in investment. And then as we do the same, as we come up this axis, we're increasing in return. So in an ideal world, a perfect world, you would have a relationship that says whatever you invest, you're actually going to improve the return more than your investment. And some investments or some improvement projects might actually fit that bill. However, there's others that necessarily, could be the opposite. You could actually invest more into the improvement than what you're going to get out of it. So just a quick kind of arbitrary line. A graph of the law of diminishing returns essentially looks like this. As you're coming up, you're making investments. Those could be improvement projects for clearing food plots, fixing fences, making access trails, all those kinds of things. You're going to see kind of a relationship that looks something like that. As you come up here in the investment, your return is going to improve, and hopefully it improves more than what you're spending, as I said. But at some point, that line is going to start to shift and flatten out. And essentially what this is saying is that no matter how much you spend, you can continue spending money on all the improvements you want. You're only going to be able to get a certain amount out of that property or home or whatever it is. So this is the law of diminishing returns. Once you move into starting to make improvements to that property, that's where you have to be careful. Certain things, as I said, like food plots, you're not going to spend a lot of money, but it's going to make the aesthetics of the property a lot nicer. It's going to make the huntability of the property a lot nicer, a lot better, I should say. And if you were to put that thing right back on the market, potentially you would do better than the total amount of money than you have invested. So as you look at food plots, trails, access roads, crossings, things that are incremental amounts of money in the spend, but have a much higher impact on the utility of the property, the enjoyment of the property, you're pretty safe. So it's a pretty simple concept. If you understand it, it will help you greatly as you start looking at properties, and especially if you are in a scenario where you're potentially going to invest in, say, a recreational property and try to improve that property and then maybe sell it later on down the road and hope to make some money. It's certainly something you need to keep in mind and think a lot about. So another topic that comes up quite a bit, usually on a daily basis for us, as we're looking at land with different people, whether it be sellers or buyers, it's the concept of cap rate or return on investment, ROI. Usually when we're working with investors, they have a couple different options, or many different options usually, but usually it boils down to I'm either going to invest in land or the stock market. Stock market, we're not exchange brokers. We don't deal with securities and investments and things of that nature, but what we do know is it's highly volatile and which makes it risky as compared to land, which is very stable. What does that mean? When an investor says, I'd like to have a farm that generates 4% return, let's say, that's important for us, and it comes up not only when we're looking at it from a buyer's perspective, but also when we're trying to educate the landowner of how an investor is going to look at it so that we can value the property. So just real quick, we got a whiteboard here. I'll go over just a real simple calculation or formula that you would use to calculate ROI and then cap rate. So ROI, return on investment, is, very simply put, it's the return on the investment. It kind of describes itself. So to calculate ROI, you just look at your annual return divided by the investment. And essentially, if you run these numbers, let's say, just for simplicity's sake, you've got 100, or maybe let's make it easier, $10,000 on $100,000 property at a zero. The ROI on that would be 10%. You're getting 10% of the price that you paid for the property back every year. So that would be a 10% ROI, which would be very high, by the way. The other calculation that's similar to this that we see more often is cap rate. And cap rate is short for capitalization rate. And that formula is very similar, as I said, with one minor change. So you have your annual return. In this ROI calculation, it's gross return. In the cap rate, it's the net, and net being whatever the annual return would be minus the taxes. So you take your annual return minus taxes. So when you're talking about return, that could be anything from the CRP payments you might be getting as a landowner after you buy the property, or cash rent if you're renting the farm out to have row crop planted, something of that nature. And then obviously whatever your investment is. So annual return minus the taxes that you pay every year, that's your net income, divided by the total investment of the property, that gets you your cap rate. So you can see these two are pretty similar. When it comes to farmland, again, generally what we're seeing is investors right now anyway are looking for about a 3.5% to 4% return. And what they want to look at is something that shows that income is pretty stable. They don't want to see that the farm generated $20,000 of income in 2018 and 19 and 20, and then here we are in 2021, the year they're going to buy it, and all of a sudden the income has doubled. People are usually a little more educated than to fall for something like that and see that you're just trying to make the return look a little higher. And so there have been circumstances where that's certainly happened. People have kind of fallen into a trap, whether planned or not. You know, they might have bought a farm that was generating stable return for CRP, and it was $250 an acre. And then here 2013 or so, when the crop prices finally started plummeting, the CRP payments eventually followed. And so they might buy a farm assuming that they're going to get 5% annual return. And when they go back to renew that CRP contract, they're going to find out that the re-enrollment rates are much lower than they were during the previous time period. And then of course the cap rate's going to be significantly lower. So good to keep these things in mind, and good to understand what you're doing when you're looking at investing in a property that has some income on it.